So listen, we often get a question, I certainly get a question a lot from advisors and home offices about performance of sustainable investments. From your perspective, how should advisors think about sustainable investing and financial performance? Is there a trade-off there?
Yeah, it's a really good question. And again, to your point, it's one we get so often from advisors. So there are a range of approaches to sustainable investing, and different investors and investment managers have different objectives, and we can't necessarily oversimplify sustainable investing to mean one thing. But that being said, if we look specifically at ESG integration as an investment approach, evidence has been building for years that using ESG information in the investment process at a minimum does not hurt performance over the long term. And the general consensus from the meta studies that have been done on this is that using an ESG lens can strengthen investment performance when done by a skilled manager. The key there being when it's done by a skilled manager. So in that way, it's similar to any other investment approach. Thinking about ESG integration and active management, it's really just more information to better evaluate dimensions that increasingly drive valuations, like, for example, customer loyalty, reputation, culture, brand value, as well as externalities that are increasingly being internalized and hitting company balance sheets, like extreme weather and natural resource depletion. The information that's out there is not standardized or regulated yet in terms of what companies are really required to disclose. The data is still very noisy and inconsistent because it's still voluntary to report by companies, which is really an opportunity for asset managers to apply that information through their own lens. And markets really are getting more and more efficient. Information gets priced in more and more immediately. So using ESG information in the right ways is really an opportunity to demonstrate value. It's an information edge. You can think about ESG integration in passive investing a little bit differently. So typically here you see managers using ESG ratings and data to construct the portfolio, and it's a rules-based approach. So there isn't really a qualitative layer of analysis being applied in the same way as actively managed portfolios. And so thinking about passive performance in passive investing, MSCI has done a lot of work on this, and overall there's the most consensus that ESG information can help mitigate stock-specific idiosyncratic risk, so tail risk, meaning that information can provide signals to potentially avoid companies that are headed for a big controversial event or a scandal, like kind of what happened with Equifax or Volkswagen. So on the whole, there may be times when the common elements in many ESG-focused funds help them outperform as a group, and other times they may underperform, right? So in 2022, ESG-focused strategies on the whole underperform primarily due to a lack of exposure to the energy sector, and in some cases, a tendency to have higher growth-oriented exposure. But if we want to actually look at another short-term time period for the performance of ESG-focused strategies, we could look at 2020 as well. And we actually did our own analysis of ESG-focused ETFs and mutual funds available on the Envestnet platform. And we found that ESG strategies outperformed their peers across US equity, international equity, and fixed income in 2020. So the bottom line here being, ESG integration lends itself to long-term investment objectives, providing a lens on long-term trends and issues like automation and climate change and resource constraints and demographic changes. At the end of the day, it will always come down to evaluating the skill of the manager, what approach they're taking, and what their objectives are. So cherry picking certain universes and years and market cycles is way too narrow a way to look at it. But Dana, I'm really curious as well, from your perspective, just to hear your thoughts on the same question around sustainable investing and financial performance. What's kind of on your mind on this topic?
Yeah, well, first I'll say, right at the end of the day, and I love how you often say this, Kylie, it's just more information. So it's kind of hard to argue against it, really, right? And it doesn't mean that, there won't be periods of underperformance, but to your point, how is that additional information getting worked into the investment? So I think often about where we started in terms of sustainable investing, and the kind of the history of sustainable investing sort of came over from endowments and foundations who were doing socially responsible investing, and that typically looked like filtering out stocks that were engaged in activities that they really didn't want to support. So it didn't have, it wasn't the ESG idea where you're adding information to the benefit of, the active managers pool, right? So that, again, to your point, you could find stranded assets or something like that. The potential for a blow up really had nothing to do with that. It had to do with punishing companies that, were engaged in activities that weren't desirable. And predictably, you had a bunch of studies come out and say, well, guess what? It turns out all these sin stocks that you're avoiding return better, which is exactly what you would expect to happen if you have a bunch of people who are avoiding those stocks. You drive up their cost of capital, you drive up the return for those who are willing to get into it. So that was sort of mission accomplished, but in our industry, I think it got presented as, well, look, doesn't work well. Well, to the point of conflating things, it didn't have the same thesis at all as ESG does. So there is a component of that. I think that's part of the discussion when you get over to ESG, which is, hey, look, if enough people are avoiding brown stocks and investing in green stocks for social preference reasons, that they kind of swamp out the information content, then yes, to a certain extent, you would expect some trade-off in performance ultimately, because again, you're driving up the cost of capital of the brown companies. But what's different with ESG is that there's an alpha thesis there around why you're doing that, which was completely lacking, of course, in the former version. So that alpha thesis is exactly what you alluded to, right? It's the idea that this information that the active manager has adds to their ability to better choose companies, right? So if there are companies with stranded assets, if there are companies with bad supply chain problems and just, controversies waiting to explode on them, idiosyncratic risk, absolutely. And I think defensiveness in general. So you look at the studies that are out there, it's early days, right? We don't have decades of performance on this stuff yet, the way we do with style factors. So it's really hard to say. And also what's going on there, which you also stated, is look, there's lots of differences among these strategies. You really can't lump them all together. To say ESG did well or didn't do well, you're taking that median, but you could have very, very different strategies that are in that label. So I think what in the long run you're going to look for is, as we coalesce around certain definitions and meaningfulness of the E and the S, we've long known that G, governance, is closely associated with quality, which is a very well-established style factor. It does tend to outperform over time. I think of the E and the S as extensions of that. It's additional information about governance type issues. In the case of environment, it's, what's your track record in terms of these externalized costs that ultimately regulators, society, your clients are going to maybe hold you accountable for. And on the social side, again, how are you acting in the communities that you're in? And does that come back to impact you in some way? So to me, it's an extension. There's a good reason to think then that we'll have defensive properties in general, possibly even, return enhancing properties over time, or at least risk adjusted return enhancing. But again, there's different things at play there, obviously, investor interest in these things. So it has to play out. But I do think that, to the extent that people are getting into these types of strategies, ultimately, our expectation is that active managers in general are going to be using this information the more available we make it. And then there really is no ESG, right? It's just a part of active management.